Hey everybody, it is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, December 14th, 2024. Hey, I hope you're doing well. I appreciate you tuning into this weekend's podcast, and hello again from Santa Marta, Colombia. I just posted a little photo that I took the other morning of the beach that I'm staying at. Isn't that nice? I wake up every morning, I take the dog down all the way down there to the mountain part, and it's just nice, and I'm wide awake and come back and ready for trading. So it's just really been nice. So just wanted to share a picture with you. But like I said, I hope you are doing well. And today's podcast, the format is going to be as follows. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily and the weekly time frame. We're going to talk about when I entered the trade, why I entered the trade, what was the setup, what was the strategy, what were the signals, and then we're going to talk about how I position size correctly based upon the volatility of the market, and then also my account size. We're going to talk about where I place my emergency stop, where I place my end of day stop. We're going to talk about trailing stop levels. We're going to talk about taking partial profits if the market moves my way by a certain amount. And then we're also going to talk about significant overhead resistance levels where I will completely exit the trade. You know, in trading, it's very important that you have a plan, you have a process and a strategy, and you follow it. There are so many different strategies out there. You don't have to trade the way that I do. There's so many different ways, but the important part is that you create the plan and then you follow the plan. You don't let your emotions get involved and get you out of a trade when there's really no signal to get out of. It's very important to be process driven, process focused. And so in today's podcast, I'll show you my process, and I hope it's going to be helpful for you. And if it is, I would appreciate if you could hit the thumbs up button. Really does help out the channel, lets YouTube know there's some valuable content here. And if you haven't subscribed, subscribe to the channel. I always forget to mention that. So yep, we'll talk about all the trades, the ones that I'm still in, the ones that I exited, when I entered, why I entered, and how I am going to manage the trade going forward. After that, we'll quickly talk a little bit about trader psychology. Always the most important skill in trading is the ability to create that plan and then to follow that plan. So it's always helpful for me to teach trader psychology, and I hope it's going to be helpful for you as well. And so that is going to be the plan. And let's run the U.S. legal disclaimer, get that out of the way quickly, and then we'll be right back. Come right back, and we'll get started.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, let's get started. So first on deck is a position that I'm still in. It is TLT 20-year bonds. I entered this position back here on the 15th of November. So why did I take this position? Well, first of all, notice the green box here. And let's go all the way back here to the 29th of May. This is what keyed me off to this particular trade. This is a down bar before we had a market structure change to the upside. And this is called an order block. And these order blocks tend to have memory. So technically what they are is the lowest close before you have a market structure change. And this is a market structure change here because we took out this swing high. And if you go from a bearish market structure to a bullish market structure, then you want to buy dips, which you can see that dip worked here. That dip obviously worked there. But in the future, when you go out into the future, if you come back to this order block, it tends to have a memory and will bounce. So this was an order block setup. This is a strategy, an order block setup. So let's go into more recent times of when I took the trade here on the 15th of November. And I took the trade for two reasons. The first reason is the order block that I just mentioned. You see we came down, touched the order block. Here we got very close and bounced. Here we got very close and bounced. The next day after I took the trade, we tested it one more time before we started to go up. But with my trading, ideally I like to have a confluence of signals. I like to have more than one signal, and the first signal is the order block, right? The green box. But the second signal is the very strong double bottom bullish divergence with a missing right shoulder. And so if you go over here, you can, as it's going down, we had a strong down move. You can see how deep these red MACD bars are. MACD is an indicator of momentum, and the lower these red bars go, the stronger the downward momentum is. So we make the lows here, then we have a rally, and then we come down here, and even though we are lower here than over here, do you see how we don't have any red bars, any red MACD bars? I studied one-on-one with Dr. Alexander Elder, and he taught me this strategy. He believes that this strategy is the strongest technical indicator there is in technical analysis. But really what this means is we're coming down here with strong MACDs, coming down with strong momentum. And then we bounce, and then we come down here again. And even though we're lower here than here, there are not any red bars. And there can be red bars, but even if they're not as deep, that's also a divergence. But there are no red bars here, and so that's why this is called a double bottom with a missing right shoulder, meaning there is no red bars, and it's a stronger signal. So that was the setup. That was the confluences of why I took the trade. One, we bounced off the bullish order block, and two, we had a double bottom and a bullish MACD divergence with a missing right shoulder. So I did get long here at $90 even on this particular trade. So that is the setup. That is why I took the trade. So let's talk about position sizing. Position sizing, whoa, I don't know what happened there. Position sizing is extremely important in trading. In my opinion, it's the most important thing. So let's talk about how I position size. And it's very simple. It's just math. And it takes into account two different variables. The first variable is how much is in your trading account. Today, let's just say there's $50,000 in the trading account. So I want to take 1% of the trading account. 1% of $50,000 is $500. If you had a $100,000 trading account, 1% would be 1,000. If it was 25,000, it would be 250. If it's $1 million, it would be 10,000, right? So it works for any amount. So let's just use the 50,000. 1% of that is $500. Now I take that $500 and I divide it by the value of the 2 ATR. ATR means average true range, and I want to double that. So the average true range is half of that. Twice of that is the 2 ATR. So I take that 1% of the capital, divide it by the 2 ATR, divided by 2.0, divided by 2.09. That tells me to buy 239 shares. This is the correct, based upon the way that I trade, this is the correct amount of shares to take based upon my account value and based upon the volatility of the market. And you get the volatility of the market reading here from the 2.09. So I enter here $90 based upon the order block and the double bottom bullish divergence. I position size, I buy the 239 shares. Now, the first thing that I do after I entered the trade with 239 shares is I put an emergency stop, exactly the value of 2 ATRs, which is 2.09, below my entry. This is my emergency stop. This is basically the worst case scenario. So I'm an end of day trader. I make all my trading decisions based upon the closing price. However, the one exception to that rule is the emergency stop. So if I have 239 shares and it gets down to my emergency stop, which is 2 ATRs away, how much have I lost? I've lost the $500, right? But the good news is that only happens about 5% of the time. 95% of the time, if you have a loss, it's going to be an end of bar stop. And I wait for the end of the day. And my end of bar stop's the bottom of this order block from all the way back in May, 88.68. So if it closes under 88.68, I'm simply out of the trade. If it just goes crashing down and gets to my emergency stop, well, I don't wait for the end of the day. Once it touches, whether it's 5 minutes after the market opens or 5 minutes before the market closes, it doesn't matter. I get out immediately. But I wait till the end of the day for the emergency stop. But again, the emergency, the end of day stop. But the emergency stop only happens 5% of the time. 95% of the time, if I have if I have a loss on the trade, it will be below the end of bar stop, which for me here is the bottom of the order block at 88.68. Okay, so we've talked about what the strategy was, of why I entered the trade, what the confluences were, how to position size, how to place the emergency stop 2 ATRs below, and then on this particular strategy, the end of bar stop is just a close below the order block at 88.68. Now, the next thing I do, once I know where my emergency stop is, my end of bar stop and the emergency stop, I place a line exactly 1.5 ATRs above my entry. This is called my trailing stop level. And if I get to my trailing stop level, then in the future, if I have a close below a previous bar's low, I'm going to exit half of the position as a precautionary measure because it's showing that it may be going down. And you'll see why that was so important in this particular trade. So if I mark the 1.5 ATRs above my entry. If it gets there, I go into trailing stop mode. Okay, so the position sizing, the emergency stop, the end of bar stop, the trailing stop level, these are all defensive moves, meaning that if it goes against me in one way or the other, I'm going to take action if it goes against me. All defensive. However, I like to play offense as well in my trading. And the way that I do this is I take partial profits based upon the previous bar's close. And so I'll show you, since I'm still in this trade, this is how I do it. I take the closing price of the day, $90.15. And this changes every day. I have to readjust every day. $19.15. And then I locate the value of the 0.45 ATR. Right now, the value of the 0.45 ATR is 47 cents. So I take the closing price, $90.15, plus the value of the 0.45, which is 47 cents. So I just add those two together. And sorry about that. I think I have some sand on the table that's making my mouse a little weird. Okay, so my first profit target for Monday is $90.62. That's just taking the closing price plus the value of the 0.45 is $90.62 is my first profit target. Then I take the first profit target, $90.62, add again to it, plus 0.47. 91.09 is my second profit target for the day. Take my second profit target, 91.09, again add to it the 0.457. And that is my third profit target for the day, 91.56. So I have three profit targets, which I just showed you for Monday. Now, I always I put orders in, three limit orders in at those three profit targets for 10% of however many shares I am going into the day of. If I have 500 shares, I'm going to place at the first profit target 50, second profit target 50, third profit target 50. If it goes down, obviously I'm not going to hit any profit targets, and then the next day I have to redo it again. But, if it goes up, you may hit one profit target, you may hit two, you may hit three, but the point is I want to take off shares when the market gives me something. Not everything, just 10% at three different levels, right? But that's the offensive part of my trading. And I think it's very important that you have both offensive and defensive moves and rules in your trading. Okay, so now that we've discussed all that, double bottom, bullish divergence, rejected the order block, got long, $90. Position size, as I mentioned, place the emergency stop 2 ATRs below. The end of our stops just a close below the order block back on the May 5th, 88.68. 88.68. Emergent or trailing stop level 1.5 ATRs above. And again, if it moves the value of 0.45 or more as it goes up, I take partial profits. So enter $90. Next day, opens lower, closes a little bit higher, not enough for a profit target. Next day, gaps up, goes up, I take one profit target off. Then we have 3 days of sideways motion here, no profit targets, no nothing. Next day moves up very strongly. I believe I hit 3 profit targets on this move up, and more importantly, I also got to trailing stop level, which means now if I have a close below a previous bar's low, I'm going to get out of half of the position. Next day came down, went below the low, but closed above, kept me in the trade. Next day, gapped up. I believe I hit 2 profit targets again. Next day, gaps up. I hit another profit target. Then we just kind of have some sideways motion here. Doesn't do anything here on the 4th. Open much lower, but reversed higher. Another profit target. Next day moved up, no profit target. Next day gapped open, hit 1 profit target. And then the next day we have a close below the previous bar's low after reaching trailing stop level. I took off half of the remaining shares that I had at this point. Not as many as when I started, right? Because I'm taking profits into the strength, which, look at it now. Do you think I'm glad that I took these profits when I had them? Do you think I'm glad that I had I have the trailing stop rule where I have a close below a previous bar's low? I took off half here. You bet I am. Obvious, right? Because we came down all the way down here. So am I still up on the trade? I am. A little. Not much. Let's see. But am I up on the trade overall? 100% I am. I think I just moved this line. It was $90 even. Yeah, sorry. Here we go. So I took off half here with close below previous bar's low based on the rule for a gain of 3.69%. And then the remaining shares that I have up very slightly, up about 0.16%. But this is a good example, everyone, of why these rules that I have of playing both offense and defense, especially in this example, are so important. If I would have just bought here and held, I would be up 0.16% on the trade, which is nothing. But because of taking the partial profits, because of the trailing stop rule, this has been a good trade. Although right here, and very rarely do you just go straight up and straight up and straight up. This is a normal market. You go up, you go down, you swing up, you swing down. So this is why the offense and defensive portion of my trading is so important. This is a great example. The remaining shares up 0.16%. And let's go to the next one. WBA. All right. This was another order block. So I use 7 different strategies. And it seems like some weeks I use a lot of the same. Other weeks I'll use something different, like a deep dip buy or a return to value V1 or V2. But I do use 7 different strategies. They all have different rules. tools. And by the way, if you are interested in learning the 7 different strategies that I use, I do teach a private one-on-one course in the evening time via Skype. It's 15 hours total time, 5 sessions. Each session is 3 hours, and it's a one-on-one course because I think the best way to learn anything is one-on-one with your instructor. I've traded for over 29 years. I have lots of experience. I love to teach. I've taught people from all over the world, from beginners all the way up to the hedge fund level. So if you are interested in taking this course with me, my email is in the link in the description. Just reach out to me. I'd love to have you as a student. I will teach you everything I know, and you'll have a skill really that you can use for the rest of your life. So WBA, which is Walgreens, again, I entered here on the 21st of November at $8.31. Why? Well, again, look back here, the order block on the 25th of September, lowest bar close before we change market structure to the upside. If you change market structure to the upside, you want to buy the dips. And I bought when it came back. Remember the memory that the order blocks seem to have? Well, yeah, change market structure here, came all the way back to the bullish order block, and I got long here at $8.31. Why? Because we came back to the bullish order block, and two, we had what is called a V1 entry signal, a V2 entry signal. Wait, it's been a while. I can't remember now. Low, yeah, V1. So a V1 consists of 2 bars, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. Now, I don't just take any signal if you have a V1 or a V2, but in conjunction of being in this order block, they give me a good signal if I have other things going on, like the order block. And by the way, if you'd like to learn more about V1s or V2s, just go to my YouTube channel in the lessons playlist, and I have a video there for that. It's a really good video. So, came back to the order block. The confluence was an order block plus a V1. Got in at 831, position size correctly, placed my emergency stop. How far below? 2 ATRs below. My end of our stops, a close below the low of the order block at 798. I placed my trailing stop level here at 887. Excuse me, and away we go. Next day, took off like a rocket ship. Took some partial profits, right? Because I hit the 0.45 ATRs. Next day, up again. More partial profits. Also got to trailing stop mode. Then we just kind of moved sideways for about a week, and then here on the 4th of December, we had our first close below previous bar's low after reaching trailing stop level. I locked in the half of the remaining shares for a gain of 4.81%. Next day, moved down again. And then we moved up here, took profit target on the 9th, and then we had a huge explosion here. I think I hit 5 profit targets, maybe 6 on this move up, and I sold into this strength. At the end of the day, well, during the day, we went above the 70 RSI and then closed below the 70 RSI. So one of the rules that I use and that I teach in my course is I exit half of the remaining shares that I have. Not half, a quarter, because I already took off half, for a gain of 20.25%. But I kept a quarter because now I need another close below previous bar's low. Never happened. And then on Friday, up 6.78 on this trade. So I have a quarter position left, and the remaining shares that I have on this particular trade looks like up about 19.83%. So, those bullish order blocks, strong indicators, and you can see this was a monster trade. I mean, yeah, obviously I wish I hadn't got rid of half here, but that's how it goes. But that's why I don't get rid of everything. Selling half is one of the only win-win situations you will have in trading, because if you sell half and it goes down, you're glad that you sold half. But if you sell half and it goes up, you're still glad you have half, right? So I love selling half. It's like I said, it's one of the only win-win situations in trading. So the remaining shares on WBA up 19.83%. Really good trade there with the order block. AGQ. All right, AGQ, simple deep dip buy. Different strategy, not an order block, but it's a deep dip buy strategy. Deep dip buy uses the 200-day moving average, the 250-day moving average, the 300-day moving average, and or a 30 RSI. But in this case, here's the black line. This is the 200-day moving average. Once we came down and bounced there, I got long at $37 even. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is just simply a close below this 200. That's it. Even if it's a penny, I place my trailing stop level 1.5 ATRs above. Next day, bounced, took a little profits, hit one profit target, I believe, maybe two, can't remember. Next day came down. Next day we go up. I hit more profit targets. Next day we go up. I hit more profit targets. This day we get to trailing stop level. So now I'm in trailing stop mode. Next day, nothing. And then here on the 6th, we have our first close below previous bar's low after reaching trailing stop level. What do? I sell half of the remaining shares that I have left, and I sold those for a gain of 5.37. Next day, huge gap up. I hit 3 profit targets, I believe, maybe 4, but based upon where it is now, am I glad that I did that? Absolutely. The next day, kind of sideways motion. Next day after that, we went up even more. I hit another profit target before this huge move down. So the remaining shares that I have on AGQ are currently only up. Jeez, apologies. Are okay. They're up about 1.8988%. But am I up more than that on the trade? Well, of course I am, because I took profits here, I took profits here, I took profits here, I took half profits here, huge profits on these big moves up. So yeah, the remaining shares only up 1.88%, but I'm up much more on that trade. But can you see how selling into the strength and then having these rules is really important? If you have a stock that just goes straight up, you'd be like, why did I take partial profits and why am I? It happens less than this kind of motion. And the other nice thing about taking partial profits is you reduce your position size, And why is that important? Because the fewer shares you have, the more likely you are to follow the plan the way you're supposed to. So, okay. So deep dip buy on this one, remaining shares up 1.88%. Okay, let's go to Caterpillar. Caterpillar, this is a short position. And let's see here. Yeah. Caterpillar here. Well, let's take a look over here at the 2 bars here in the red. This is what is called a bearish island reversal. A bearish island reversal is when you have a gap up followed by a bar, one or more bar sideways, and then a gap down. So yeah, really good news here. The sentiment was really good, really great. And then for no reason, kind of out of the blue, you gapped down. And when this happens, it's bearish. And so I could have gotten short right here when the abandoned baby happened. And by the way, if you want to learn more, I'm sorry, the island reversal happened. If you want to learn more about abandoned babies, island reversals, they're the exact same thing. The only difference is one, the island reversal consists of 2 or more bars. An abandoned baby is just 1 bar. That's the only difference. So when this happened, I was waiting for a check back. I was waiting for a move back up into the bottom of the bearish island reversal. And this is where I got short. I got short here, $402.30. So on these abandoned babies, on these island reversals, I don't take partial profits. I simplify this particular strategy by having a 2 ATR stop to the upside or a 4 ATR profit target to the downside. So if I'm right, I'm going to make twice as much as if I'm wrong. And in my experience using the abandoned babies, using the island reversals, I'm right about 70% of the time. So 70% of the time I make 4 ATR profit, 30% of the time I lose 2 ATR profit. So that's a pretty good proposition if you're making twice as much 70% of the time. So I have my 378.50. So you can see I almost hit my profit target on Friday. Not quite. But so I have an order in to get out of the position here at 387.50. I didn't quite get there, so I'm still in the trade, but this trade has been a monster. And so far, this trade, this short, is up 5.75%. Again, using the bearish island reversal. And again, if you want to learn more specifics about island reversals or band babies, just go to my YouTube channel. So this one's very, very close. I honestly, if I had been in front of the computer, I probably would have taken it off because it was so close, but I didn't because I'm on vacation. So we'll see Monday. If it heads down a little bit more, then it'll get taken out of the trade, but very close to my ultimate profit target with a gain on this short of 5.75%. Intel. All right, Intel is a position that I took here on the 10th of December. Why? Okay, we're going to go back to bullish order blocks. Here you have the green, and I've had multiple trades on Intel with this, but here's the green. This is the order block. Go all the way back here to the 7th of, what is that, August? Lowest bar close before market structure change that happened here by the dip. I bought here. I can't remember. It was like 1958, and I sold somewhere up in here. But look, we are back to this bullish order block. And remember, with the order blocks, they tend to have memories. So I did get long Intel on the 10th of December here at, what is that, $20.13. The confluence was, one, we are in the bullish order block. But two, during that day, we went under the 30 RSI and closed over the 30 RSI. That's a deep dip buy, right? That's a strategy, again, that one of the main strategies that I use is a deep dip buy and teach in my private lessons. So that was a confluence. It was a combination of an order block, bullish order block, and a deep dip buy signal. So I got long here, $20.13, position size correctly, placed my emergency stop 2 ATRs below as always. My end of bar stop is simply going to be a close below the 30 RSI. It's pretty close. Right now we're at 34.47. If we close below 30, I would simply get out of the trade. So I got in at 2013, placed my 1.5 ATR trailing stop level above. The next day, it was down a little, didn't do much. Thursday had a nice up day. I did hit one profit target, so I took 10% of the position off at a profitable level. And then Friday, we were down a little bit, down 2.2%. So this particular trade, if I can get it, up about 0.88% on the trade, but it's only been a 3-day trade, and like I said, I did hit the one profit target there. But right now we're at 34.47, so if it closes under the 30 RSI, I will just close the position. However, if we close under the 30 RSI and then open up again above the 30 RSI, I'll take the trade again. But hopefully that won't happen. Hopefully it will go up. I don't know. We'll see. Not at trailing stop level. So new trade here on Intel, order block, and a deep dip buy combo up 0.88%. And then last but not least, on the open trades, Lockheed Martin LMT. I did take Lockheed Martin on Thursday here after this huge sell-off. My gosh, but it did get to a level that was interesting to me. And what is that level? Well, this is a little bit of an unorthodox trade for me, but it's a bit of a channel trade. You see the low here, you see the low here. Draw those lines out. This is a channel. So if you draw this channel into the future, do you see how on Thursday we went below the channel? No more sellers down here, went up, so it rejected the channel. In addition to that, we also rejected the negative third ATR channel. This is this line here. 92% of prices tend to, when they get to the negative third ATR channel, stop going down or go up. So the confluence for me was this rejection of this channel line that I drew and the rejection of the negative third ATR channel. So I got in at 497 even. I placed my emergency stop 2 ATRs below as always. And my end of bar stop on this particular trade will just simply be a close below this channel line, because if it loses this channel line, now it has the resistance of the channel line above it. As of right now, it has the it below, so it has support. So this one is down slightly, down about 0.5%. So those are the current open trades. Just to recap, TLT. The remaining shares that I have on TLT up 0.16%. WBA, the remaining shares I have up 19.83%. AGQ, the remaining shares I have on the long, up 1.88%. Caterpillar, the short, up 5.75%. Intel, the remaining shares I have up 0.88%, and Lockheed Martin, the one current loser, down 0.5%. So those are the daily trades, and let's take a look at the weekly trades. I have both open and closed trades on the weekly, but let's start with Budweiser, BUD. I bought Budweiser yesterday, Friday, because that is when weekly bars close, is on Friday. So that's where I made the decision. And if you've been watching the channel for a while, you know I've been talking about Budweiser for a while. And look, again, these are weekly charts. These are weekly bars. The green box here is what? It's the lowest bar close before market structure change. So if you come back to the bullish order block, that is the area theoretically where it should bounce. And so we are currently right in there. We are right in the order block. But I did get long. And why? Well, you heard me talk about V1s, V2s earlier. This is why. We had a V1 this week on Budweiser. Bar 1, bar 2. Bar 2 goes below bar 1's low, but closes above bar 1's close. That's the signal. So the confluence on this particular trade was 1, being in the bullish weekly order block, and 2, the V1 that got me into the trade. So I got into the trade 53.43. It's exactly where it's at. My end of bar stop, my weekly end of bar stop is going to be a close below 51.10. And then I have, of course, my emergency stop down here, 2 ATRs below. So this one completely even, just barely got into that on Friday afternoon because of the pullback into the bullish order block, and then the V1 was kind of the trigger to get me into the trade. So we'll see what happens with Budweiser. And then last but not least, Adobe. Okay, so Adobe, I got into Adobe here on the weeklies on the 8th of November. Why? Okay, so this is a deep dip buy. You can see the black line, that's the 200 weekly. The week before we closed under, the next week we closed over. That's a simple deep dip by using the 200 moving average. Close under, close over. But in addition to that, I also had a V2. I talked about V1s. V1s consist of 2 bars. V2s consist of 3 bars. Bar 1, bar 2, bar 3. Bar 2 goes under bar one's low, bar three closes above bar one's close. I got in I got in at 494.68, but the confluence was the close under, close over at the same time we had the V2. So I got long 494.68. My end of bar stop is simply a close below the 200 week moving average. Place my emergency stop 2 ATRs below, and then of course I placed my trailing stop level 1.5 ATRs above. So the next week moved up strongly, nicely, took some profits, moved down. Next week didn't do much. Next week didn't do much. The week before last had a nice move up, took partial profits. But I exited here at 548.90. Right now it's 465.69. Why did I exit here? Well, again, back to the rules. I don't hold through earnings. And I told you last week that I will get out of Adobe before earnings. And if it goes crashing down, I'm going to be glad I got out. If it gaps way up and goes higher, well, too bad. But yeah, I don't like to hold through earnings. It's really a way to put your capital at risk. And so right before earnings, I got out here at 548.90, and that was the place to get out because earnings were not so good, and this was a gain of 9.73%. And had I not had that rule, look what would have happened. I mean, how much was Adobe down this week? 15.78. So really great trade there, locked in a gain of 9.73%. So on the weeklies, Budweiser, completely even new trade, and exited Adobe for a gain of 9.73%. So those are the current positions and why I entered them and how I'm going to handle them going forward. Okay, so before we look at next week's trades, just want to talk a little bit about trader psychology. And this is from my friend Stephen Burns. Steve Burns is a great trader, great author. Check out his books on Amazon.com. A mentor of mine, taught me many things. And so when Steve says something here, I want to listen. So Steve says, position sizing determines your destiny as a trader more than any other factor, regardless of strategy. Position sizing determines your destiny as a trader more than any other factor, regardless of strategy. And listen, it's really true, everyone. I've always said this. In my opinion, position sizing is the most important part of trading because you can be as patient as you want, having the best setup as possible, but there's no guarantee that setup's going to work. And if you position size too strong, too large, you can lose a lot of money and really a lot of bad things can happen. So what I showed you earlier with how I position size, if you use that, it's going to keep you out of a lot of trouble. But you can have horrible trade after horrible trade after horrible trade after horrible trade. But if you've position size correctly, you're going to be okay, right? Because eventually, if you're using good strategies, eventually over time, your trading edge will kick in and you'll start have winning trades, you make it back and so forth. But if you bet too big on any one particular setup, or you have a string of 3 or 4 losses where you have large positions and you lose, man, it can really turn your life upside down. I had a student of mine that when we first started our classes, we talk about position size, obviously, and I was so surprised at the position size he was using. I was like, look, I really would recommend that you position size smaller because these position sizes are so big. He goes, yeah, I know, but the market's going up. I'm like, yeah. Well, the markets that he's traded went down significantly since I worked with him, and I really hope that he took my advice. So take my advice now. Position size conservatively so that if you do get into a drawdown and you have multiple losing trades, you can recover. It's the most important thing. If you lose all your money, you're done. You're done. And it's a lot less stressful and it's a lot more holistic way to trade. So that is my advice. Position size conservatively, You don't have to do it the way I showed you, but no matter what, please do that. It's going to uh, avoid a lot of heartache. A lot of heartache. Okay, I've been trading a long time. I know these things. All right, I know of what I speak. So, all right, let's get to the trades, potential trades for next week. So, every Friday night, I go through my entire watch list and I go down through each one slowly, meticulously, one by one, and I look for potential trades for next week. So there, and I have identified what I have. I have 5 here on the daily time frame, and there's also some on the weekly time frames. But I've identified 5 here that they're not where they need to be. What I like to do on Fridays is go down through the watch list and go, okay, here is AMD, for example. If AMD gets to this level, then I'm going to have multiple confluences. Maybe it's an order block, maybe it's a deep dip buy, maybe it's both of them together, maybe it's a double bottom bullish divergence, all this kind of thing. But the key is be patient, look at charts, and go, okay, if it gets to this level, that's the key level to buy. It doesn't mean it's going to work every single time, but over time, you're going to make a lot more money doing it this way. And so these are the 5 that I'm going to show you. They're not where they need to be yet, but if they get there, I'll consider taking the trade. And I also always say that here I have 5. Potentially next week, all of them could trigger on the same day. So does that mean I'm going to buy all 5 of them? No. If all of them triggered on Monday, I would have to narrow it down to the best trade. And how do I do that? How do I separate them? Well, I give each one, I guess, what you would call a quality score. You know, if it has one entry signal, but the other stock has 2 entry signals, then obviously I take the one with 2. But I don't just look at that. I look at multiple signals. I look at the risk to reward ratios. I look at the higher time frames to see if the higher time frames telling me something. I look at the relative strength of that particular market. For instance, if the market was down, but um, one particular market was up, I would give that a point as well. And so it's important. This is how I trade. This is how I narrow down to the best one. And again, this is what I teach in my one-on-one course, how to differentiate which market to choose if you have multiple on the exact same day. And I think it is really helpful. And so let's get started here with AMD. All right, well, AMD has really obviously sold off here, hasn't it? But what I'm looking at on AMD is a deep dip buy. Right now, we're at a 33.52 RSI level. So in the deep dip buy that I use and that I teach, we use the 200, we use the 250, we use the 300-day moving average, but also the 30 RSI, a rejection of the 30 RSI. And right now we're at 33.52. So next week, if we go lower and intraday go under the 30 RSI or over the 30 RSI, that would be a valid signal. Or we close under the 30, close over the 30, that would be a valid signal. Or if we bounce at the 30 RSI, that would be a valid signal. But again, remember, I like to have confluences. What's the confluence? Well, look at the MACD. Here we're going lower, We have very deep red MACD bars, don't we? But then we rally, get some green. We are lower here now than we were back in November. Would you agree? I mean, we definitely are. But look at the MACD bars. The MACD bars, the momentum bars, are not as deep here as they are over here. Why is that important? It's showing that the momentum from a MACD perspective is slowing down. And if you're slowing down, the selling momentum is slowing down. What it really means is you're running out of sellers. And if you run out of sellers, the implication is the market is going to go up. So that is why this got on my radar here, AMD. We have a double bottom, bullish MACD divergence. We're very close to a 30 RSI level, which is, and if we reject that 30 RSI level, that's the signal, giving you a good risk to reward ratio. And then also the negative third ATR channel here. 92% of time, prices tend to stop going down or go up when you get here. This is a little a bit of an interesting case where we did get to the third, then we bounced, we got to the third, then we bounced, and here we are again near the third. But I'm a lot more interested here than I would be here, because here you have no divergences. You have no MACD divergences. Here you do. Here we got close to 30 RSI, and we did bounce a little at the 30, but this is a much better picture overall, because the double bottom bullish divergences that are happening here that didn't happen over here. So that's what I'm looking for in AMD next week, is a possible rejection of the 30 RSI for an entry signal. My end of bar stop would simply be a close below the 30 RSI. If it closes above, goes under the 30, over 30, I would definitely consider taking it. But if it closes back under, that would be my stop. And in addition to that, when I talk about channel lines, if you draw this channel line out, if we connect these two bottoms, look, that would be another signal down here. That would probably be under 30. But anyway, that's why I drew the green box right around here. This is where I think the sweet spot would be for me, because if we got down to here, it would be under 30, over 30. And so anyway, that's what I'm looking for. I'll be watching AMD closely next week. Alibaba, BABA. Okay, well, you see the green box, so that's a hint. That is a bullish order block. This is your lowest bar close. This is on the 5th of December. This is your lowest bar close before market structure change. So if you're in a downtrend, then you change to an uptrend, you want to buy the dips. So the dip to me would be if we go down and reject the top of that order block. Let's see, the order block is at 85.10 to 83.92. So anywhere in here, technically, that is the order block. But the way that I'm going to look at it is, if it goes down, touches it, bounces off, that would be my first potential entry. If it goes down lower, rejects the bottom of the order block, and then closes back in, that would also be an area for me to enter the trade. Now, we do have a lot of support down here, the 200-day moving average and the negative third ATR channel. So for some reason, if I bought here and then it closed below the order block, I would get out. But then if it went down lower and rejected the 200-day moving average, then I could get in again there. But somewhere in this area right here, I think that order block area, I think that will hold. But again, we have changed structure to the upside by taking out this swing high here. So when you change market structure from bearish to bullish, you want to look at buying the dips, and I would consider buying the dip on Alibaba somewhere here in this order block. Berkshire Hathaway, BRKB. Okay, so I have the bar here again, or the green block. This is an order block. Your lowest bar close before market structure change. So if BRKB, if Berkshire Hathaway comes back into this order block area here, that's the potential buy. But where exactly? Well, again, if we come down, bounce off the top of this order block, I would consider that. If we have a V1 or a V2 in the order block, I would consider that. If we go lower, reject the bottom of the order block here, I would consider that. Or right now we're at a 38.43 RSI. If we came down into the order block and then rejected the 30 RSI, that would be a potential entry for me as well. Just exactly like the trade on Intel that I took. So that's BRKB. GDX, this one's pretty easy. This is a simple deep dip buy. You can see back here on the 14th of November, we bounced at the 200-day moving average and did fine, did great. Now we're coming back to it. So if we reject this 200-day moving average, would I consider taking it? Yeah, I would. And the reason really that I would is when something comes back to the 200-day moving average, I always like to look in the past and go, did it respect it last time? Well, it did. Does it mean it's going to respect it this time? Not necessarily, but the likelihood is higher because buyers certainly came in here. That was clear. Are they going to come in here again? I don't know, but I need GDX to show me that it's rejecting this 200-day to get me interested. So that's what I'm looking for, some kind of bounce, intraday rejection bounce, close under, close over the 200 to get me long on GDX. And then last but not least is Exxon. Boy, Exxon has really sold off here, but it is getting into some key levels. This is a deep dip buy. Okay, so deep dip buy again uses the 200-day moving average, the 250-day moving average, the 300-day moving average, or the 30 RSI. And oh, by the way, deep dip buy. If you like video courses, I have an online video course at udemy.com. The link's in the description. I have a great course there. I think it has 4.8 or 4.9 stars on Udemy. I have sold so many around the world. It's very affordable. It's a 9.5-hour course, and it really a great course. So here we are talking about deep dip buys. And I mean, obviously I don't have 9.5 hours to talk about all the rules, but if you are interested, that's a great course. Obviously not as good as the one-on-one course because that's 15 hours and it's one-on-one, but it's a really good place to start to learn the deep dip buy. Deep dip buy is a great strategy. So we are in deep dip buy territory for sure. We closed under the 250-day moving average. We have the 300-day moving average underneath us. We're at a 2731 RSI. So for me to get interested in Exxon, and I am interested in Exxon, I'm looking for one of two things. One, we go lower and reject the 300-day moving average. If we reject the 300-day moving average, meaning that we go under it during the day and maybe close back above, that would give me a very good risk to reward ratio at a very key level, the 300-day moving average. Alternatively, if Monday we go up and close back above the 250-day, that is also a valid trade, and it would also be a double valid trade because if we close back above the 250, we will also most likely close back above the 30 RSI. And that is one of the strongest confluences in deep dip buys when you go under 30, over 30 at the same time you go under, over a major moving average. So this is what happens in trading a lot. Things for me either have to go lower or they have to go higher. Right now we're kind of stuck in purgatory here, under the 250, above the 300. And under the 30 RSI. So again, just to be clear, if we go lower and reject the 300, then I'll consider getting long there. If we go higher and close above the 250-day moving average, most likely we'll also close above the 30 RSI level. That's a nice confluence. And throw a sweetener in here, the negative third ATR channel. If we go up on Monday, we probably will have rejected the 30 RSI, the 250-day moving average, and the negative third ATR channel. So either going up or down, I'm interested in buying Exxon. Okay, so those are the dailies, and then let's quickly look at the weeklies. I only have one. I have Johnson & Johnson on the weekly. Again, weekly trades close on Friday, or the weekly bars close on Friday. So I will have to make this decision next week, but this is, I like this setup a lot, everyone, because here is these are weeklies. Here's your order block back here. This is the lowest bar close. This is on April 26th. This is the lowest bar close before we change market structure to the upside. Now we've come all the way back down into that key area, and we're flirting with the 300-week moving average. Again, deep dip buy. We're flirting with the 300-day moving average. And we're also, I mean, look here. Look at all the support that we had here before we moved up. Is it likely that we're going to find support here again? Sure, it is. It's probably more likely than not, but it's not 100%, right? We could have another leg down. So that's why this 300-week moving average here is so key to me. One, it's going to show me that there were no more sellers under the 300. And two, it gives me a very defined risk. If it goes under the 300, closes back above, then I position size, place the emergency stop. But I just simply know that, hey, if it in the future closes under this 300, I'm out. That's just it. But if it closes above, I'm going to stay in. I'm going to take partial profits, so forth and so on. So hope that made sense. So anyway, I hope this was helpful for you today, everyone. I hope these potential trades next week made sense to you. If you have any questions or comments about anything I mentioned in the podcast, please put it in the comments section. I'll do my best to get back to you. Again, if you're interested in taking my one-on-one course with me, love to teach you. Love to meet you, love to teach with you. Generally, the way we do it is if you send me an email and say, hey, Greg, I'm interested, we just have like a 15-minute free Skype call, just get to know each other a little bit. You can ask questions about the course, about the format, about the syllabus. Me personally, I'd like to learn a little bit more about you, your trading challenges, your goals. It's definitely not a sales call. It's just a get to know you call. And then when we're done with the call, that's it. And if you're interested, you're going to have to get a hold of me again and say, Greg, I want to get going. And I hope you do, because I love to teach and I know you're going to learn a lot. Keep in mind the Udemy course, the Deep Dip Buy on Udemy, the link's in the description. And I always like to leave off with, please try to go out and do something nice for somebody today. If we all did one nice thing for another human being, the world would be a better place. If you could also go out and do one nice thing for an animal, that would be great. I was raised with a lot of animals, and I know they like acts of kindness just like we do. So thank you so much, everyone. Have a good rest of your weekend, and God willing, I will see you next week from Columbia. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.